Welcome guys, smartholding.com here, and I'm going back to the waterfall model. I'm going to go into a sensitivity that I've built. And so what we've done, in order to have basically 5 scenarios that allow you to adjust all of these inputs dynamically, the debt, the revenues, the exit cap, vacancy, so everything is dynamic and you can look at the investor and sponsor net cash returns over the life of the deal and the net cash splits over the life of the deal. I had to build basically 5 versions of all the inputs and outputs. So we've got, you can see here, 5 versions of all the inputs. And in this scenario, I've just simply tried to keep everything the same. Let me put this back. Everything's the same in each of the inputs right now, except for the expected rental income per month. So I've lowered it from 50 to 48, 46, 44, and you can modify this however you want, but I just did that because it's the easiest to understand. Is basically saying, okay, the less money the project is generating, that will change how the hurdles work or how the hurdles get applied because you've now got less. If I step back real quick, a high level overview, an IRR hurdle model is just going to be used so that it's to entice investors, and give investors confidence, because you're basically saying you're guaranteeing a certain return up to a certain internal rate of return level. So here we're just saying, it's based on equity contributed, but you can make this anything. Like, even if the developer doesn't contribute anything, they might start at 5 or 10%, or they could start at 0% and the investor gets 100%. But then, as soon as the cash flows that are being returned each month result in the investor reaching a 11%, we're now going to split any cash flows after that hurdle was made in a different manner. And this is the promo to the developer. You can see I'm just backing into the promo by saying, okay, the investor gets 80%. After 11%, they're going to get 70. Therefore, the developer now gets 30 instead of 20, and so on down the line. And then this model does 3 hurdles. After the final hurdle is reached, it's actually going to go to a 50-50 even split. Now, this is because 9 times, 99 out of 100 times, the developer is going to have a less than 50% share. Um, well, I shouldn't say that because I don't have that much experience in these deals, like actual deals happening. But any deal I've done for anybody that's come to me, has the developer starts lower and then gets higher up to 50%. I guess technically this could be switched around, but it's not likely. The whole point is that you get investors to come in, the developer puts in little or no equity, and then the developer, runs the whole project and tries to get the most value for the investors. The more value they get for the investors, the higher they're actually going to get a share of the profits. And if they don't get a certain hurdle for the investors, they might not get any of the profits. So it's to align incentives and provide some kind of carrot for the developer to try to do a better job on getting the maximum amount of cash flows to the investors. And the investors are saying, okay, if you do that, if you get me more money, I'm willing to give up some of the profits to incentivize you to get more for all of us. So that's the general structure of this. So in a scenario where we never reached 11%, that would mean that any cash flow that's available is split 80-20 the entire time. If we get all the way past 17, it means any cash flow up to 11% is split 80-20. Any cash flow between 11 and 13% internal rate of return is split 70-30, and so on. It's almost like a tax bracket. Like, you pay a certain amount of taxes on 0 to 10%, then anything over from 10 to 20 something percent, you pay that rate. And then from 23 to, it's like 30%, you pay a different rate on that money. So it's each hurdle you have a different rate being applied. These W1 through 5 are all the waterfall calculations for each of the scenarios. So this is the first scenario, and you can see basically you have the cash going out in the first month and that's just based on some startup costs that you can manually enter here in month 0, and then any financing will come in also, and the cash flow will be calculated here. We're just doing month 0 is going to be where everything happens, and this is the initial investment or equity needed, either all from investors or some from investors, some from sponsors. So this is what is populating. And we have exit value. We have any debt payback on the exit when and if that does happen. You can see here the actual term of the loan is for 20 years, so there's no debt at year 20, but you could change the assumption so that there would be if you were to exit earlier. And you can see this is the cash available to be split. So that feeds directly, and you don't necessarily need this model. All you need is some model that has monthly cash flows available for distribution, and you just simply plug that into each month of the model. And you might have some tricky things at the beginning, so you might have to hard code in the first month or two of the actual starting cash flows of the investor and sponsor. So in the sponsor, it doesn't matter if they don't invest in anything because the IRR is obviously based on the returns you're giving to investors. So it's okay if there's no actual return for developers. They're just making money based on their performance to the investors. So you can see here, this is just checking. You can see the net present value formula. It's checking if the cash flows up to this point to the investors is equal to, um, or I mean, is less than the hurdle rate. If it is, it is just multiplying the cash flow to each by the hurdle. So you can see this is 80-20, 80-20. Now the reason why when you go on the returns or even here that these are not perfect to what the hurdles are is because you have some carryover like in a month where you've actually made the hurdle. It's going to split some of the cash in one way, some of the cash at the other rate, and that results in when you get all the way to the bottom, like on the final cash split, this is actually this is the only column W and X are what you actually use, and this is pulling from all of these columns over here to get the final split. And you can see these two equal the cash flow 20,129 right there. So when we go switch, let's see, there's a switch. So this is when we're in the next tier. You can see there's obviously nothing being split at the base rate. The investors are nothing's being split at the hurdle 1, so we're past that. And you can see, oh, hurdle 2 is what's being applied here. So some of this cash flow is hurdle 2, and some of it is hurdle 3. You can see there's a balance here, 3,800 after this has been split. You can see 19,118. Well, there's still 3,000 left. So that's saying that the investors now reached their hurdle 2. They're now moving to hurdle 3. In that month, there's 19, 22, 9 less 19, 1 is about 3,800. And then that's getting split at this 50-50 rate. So, or no, that's getting split at hurdle 3. And then there's nothing remaining beyond that hurdle, which is saying there's nothing past 17%. So it just goes to right here directly, and it's not split 50-50. It's still at, you can see here, if we divide this by the cash flow that was available, it's going to be, yeah, see, it's a little bit of, it's not directly 60-40. It's going to be some combination of the hurdle rate return. And I'm just doing this so you can really see the mechanics of how the calculations are going. And then you'll know why the sensitivity makes sense. So yeah, you can see it's not perfect 60-40, it's 59.2, 40.8 for that month. So those tiny discrepancies will just means that these rates will never be exactly what the hurdle is. They could be if everything splits exactly down the line, but that's not likely to happen. And yeah, here's hurdle 2 is 60-40. So that's what it's close to because that's where most of the cash is being split. But then you've got a little bit more in the next hurdle, which is a little bit less for the investor, a little bit more for the sponsor. So this is actually aggregating, it's checking all this stuff and figuring out what the actual cash flow split should be for that month. Now you can see in month 66, we've actually met the final threshold. So now anything after that is split evenly. You can see 11,497, 11,497 for both. And all this is completely dynamic based on your assumptions. So now you're splitting everything evenly. And at the end, this is the exit. You're also splitting that evenly, and then here's the final returns, and then you can actually calculate what the IRR ended up being. And so these rates down here will always be higher than whatever hurdle rate they were at. So obviously we were beyond the max, so there's what that hurdle is. Now look at, interesting, if you say, let's do scenario one. Let's say they exit in really in the first year within 12 months. So January 19, and let's say they actually exit. Let's put this really high and say, well, here, this is a better way to show it. Let's just put in the pro forma, let's say, this is not realistic, but just let's say $1 million came in month 10. Just so you can see how the hurdles really work. So now we've got month 10, so really early in the project. Look at that. So you're already in month 10. You've now went all the way through all the hurdles, and you see there's plenty of cash that's going to be split. Keep going. Up, keep going. There's still balance there. 406. So you're actually splitting 400,000 of the cash flows at, well, this is almost, because this is actually, so 400,000 is going to be split 50-50, but then 30,000, which is the difference between this, is going to be split at that rate, that hurdle, and so on. And you can see this remainder is really small, meaning that we still need to go up through the hurdles to distribute. So out of the total 973,000 that happened in month 10, we're not super close, but pretty close to getting close to 50-50. And then you can see here we're 50-50, 50-50, and 50-50 on the exit, which is in month 13. And you can see the IRR is super high. Because, well, not super high. Well, that's the monthly. Yeah, that is super high. You're 641% for the investors. So you can see how that looks on this here. Now let's undo that so it's not, I haven't broken your formulas. Undo that. Okay. So now you can see, you can play with these scenarios and see the final cash splits to the investors and sponsors and the percentage that end up being based on these results. And so what you see here in scenario one is obviously the best. It's the most money that's being made at 50,000 rental income a month. So here's your splits, nearly 50-50 for the whole time, and here's the investor and sponsor splits. And these would be all the available cash flows for the entire project, and this is how they're ended up being split. Now we go to C2. Now you're only making 48,000 rental income a month. Well, now look at, the investor is giving or taking a little bit more, but they're actually making less. Go to C3, making even less. 46,000 rent a month means less revenue. So now the investor wants a little bit more of the share, but they're still making less overall. So you can see how this works. If the cash flow results in the investor only making 1.7 million or 1.8 million, they're going to say, well, I want a bigger share of the profits because my internal rate of return is actually not that high. And then they're saying, if you can get me 5 million, I'm willing to split it 50-50 with you, with the sponsor. So the investor wants obviously to make 5 million, holding all else equal to, rather than 1.8 million on the same money invested. All these scenarios have the same amount of money invested by the investor. So obviously they want 5 million rather than 1.8 million. And they're saying if you can give me 5, I will give you half of it almost. Rather than here the sponsor only at 38%, and that's going to be 38% of a lot less. Or I'm sorry, investors on this side, but same goes. So investors like, well, I'd rather have 5.3 million than 2.8 on the investment. Now the investment obviously can. Right now the investments are being held equal at 2080. So you can see here whatever this cash flow requirement is. Let me go 750,000 because we're financing 500 of the total required cash of 1.2 million. So saying you got 750, the initial investment is 777, and that's because we have a couple months of negative cash flows here while we're still not collecting rental income yet. So we're still construction, and that's why also I've done the property tax and insurance actually start right at the beginning, but the operational stuff doesn't begin until the actual cash flows begin. So you can see the total capital required is 777. So that's what is being split by the investor and sponsor. You can see there's 622 for the investor and 155 for the sponsor, and you can see that's right here, 622, 155 for each. So these are, I haven't put these on this summary, I've just put them on the returns for each scenario, but that's what this is here. So you can see the sponsors only committing 155,000, investors are committing 622. The split on free cash flow is 80-20 at the base. Here's the total cash return after everything. And this is not net. This is total. And then here's the net, which matches our final splits here. You can see 5-1 and 5-3. So this is basically you're saying you put in 155, you took 155 out of the bank, and you gave the bank back 5.3 million, which is a net of increase of 5.1. So this is your return on this investment. This is the total return. Okay, and years held. And I've done some other calculations like return per year, which is just based on the net or the total amount divided by the amount of years. So this is your total. This is not just the profit. This is actually your total return for all 5 scenarios. So hopefully this helps people understand, preferred, or I mean, I guess in this you could think of the preferred return as this. So before you're saying the investor saying until this is my overall return on an annual basis, this is how the cash flows are going to be split. Then is when the project starts to return more, they change, the splits change. And it's all to incentivize for more money to be made for the investor, and the sponsor will also make more money if they can if the investor makes more. And you can see everything broken down into each of the scenarios. You can see the overall aggregate results, and you can play with these assumptions. Like you can do different start times for revenues. You could change the rental income per year, the rent increase, vacancies, exit, cap rate, and financing, and that will all update. Like here in C5, let's just put financing to 0 and see what happens. And I'm going to tell you the numbers will go down because you're putting more up front. Yeah. So now you're only making 1.5 for the sponsor, 3.4 for the investor. 61. Or rather 1.8. The sponsor's making less, investors making more. And but that's because the actual investment the investor's making is higher. So you can see if we go first, let's look at their IRR. So if we go to scenario 5, do I have IR? No, I have it on here. So we're in scenario 5, and this is going to be, actually I probably should put this over onto these as well. So the IRR is 14%, 14.16% for the investor when no amount is financed. So 14%, remember that number. If we put it back up to 500,000 for financing, meaning that there's less required capital, now, yeah, now you're higher. So you're at 16% return. Even though the actual cash amount is lower, you're getting a higher return since some of that money is being financed. So that's why that was. So when you change different variables, it changes the whole deal, but you can see the aggregate results of that deal here. Now I'm going to actually add, so let me pause the video. I'm going to add an IRR for sponsor investor right here as well, because I think that's helpful. One sec. Okay, so I added on each of these, we can now see the investor and sponsor shares. And the reason why the sponsor is always going to have probably a higher one is because if they put in any equity, it's going to be a lower amount, and then they're getting their share based on their performance. And obviously, investors just put in money and they don't have to deal with the things that the sponsor is trying to make work. And so that's kind of how all of this is, why this is run like it is. Now, keep in mind, these hurdles I've just put in here arbitrarily. These should be decided by what you think is fair enough. I mean, a base rule is usually this first hurdle is like between 5 and 11%, probably not more than that. And notice this is IRR. This is not straight ROI. So IRR takes into account time and not just the cash return. And that's why, like on these, the IRRs, I can't just do the net cash divided by the investment divided by the amount of years that it was held for, because that doesn't take into account um, the nature of the cash flows. For example, if you had a big exit in 10 years, the ROI would take that the same as if the big exit happened in 5 years or 2 years. But the IRR, if the exit happens sooner, the IRR is then higher because that's just the rate that you have to discount the future cash flows to, so that the present value of that equals the initial investment. So the higher the IRR is, the better. It's fairly misunderstood, but that's what it is. So it's really important for investors to know what it is because it shows you the effect that timing and liquidity have on your uh, returns. Uh, okay. So I mean, I think that's it, and I think this right here is the best illustration of the effects of the hurdles. You can see as you go up in the hurdle rate, you split the cash more evenly, but look at the cash flow to the investor is higher. And the actual, I don't know if it's going to be helpful, but the actual investment is the same in all these scenarios. And that's the key right there. So we could do original investor equity or no contribution, original sponsor contribution. So let's put those in there as well. And then you could see it's going to be the same for every one of them, whatever it might be based on the assumptions, but it will change simultaneously. So the original investors turn 622 into 2.8 to 5.3, depending on how well they do. But this is the same. So obviously, investor wants 2.8. Would rather have 5.3 million on this investment than 2.8. Okay, we'll paste this into each one. Now, the reason why I want this in each one is so you can adjust the main assumption and see the final results right here without having to move around. And then here's context for some of the numbers, and just so you can see more of what is going on in one spot. Now let's say I change the hurdle to 20% here. Now let's see how that changes the cash flows. So not a whole lot, but 2844 1796. Now the reason why this did not change at all because we never reached the hurdle. So if you go to your returns tab, you can see, what was that, on the fifth scenario. The hurdle 3 is the same cash split as this. That's because we actually never broke past the hurdle that gets us to be able to split it 50-50. And that's kind of what this shows, is it shows you what happens if all the cash is split through the base. It shows you what happens if you only reach hurdle 1, hurdle 2, or hurdle 3. Because in the waterfalls, you're actually, a bonus of this is you're actually getting the cash flows if you made it through the base and through hurdle 1 completely. And you can see that those cash flows here. And let's go back here. So hurdle 1, you can see it's 13 and 3.3. Yeah, 3.3. We're in scenario 5. So 3.321, and then the remainder is actually not going to be any of this stuff. It's actually just going to be the total cash flow. How did I do this here? I know this was a bit complex. So the total cash distributed is 4.641. And it's not that. No. So it's this minus. So this is the total cash that the investor gets. And this assumes that because you have to have this here to do the whole calculation, even though this isn't what the final split is, the final split is all the way over here in the final. This assumes that you never get past the first hurdle, and so if so, then you split a certain amount at the base and then the rest at hurdle 1, and that equals 3.3 million to the investor, and then the remainder cash flow would be the 4.6, which is just the total cash flow less this. So it's the same amount of money in every split here. You can see it's 4.641 in every split, but the way it's split is different based on how far you get. And so the final is doing that final. This is just, all these are doing here is summing up the results of each of these tables all the way over to the end. But I think that's interesting to see, well, what if, so you can play out scenarios like, what if I only reach hurdle 2? What do the cash flows look like for the life of the project? Or what if I reach hurdle 3, but never the final 50-50? So I think that's helpful to see. Now, what did I change? Oh, I changed the hurdle rate to 20, so put that back to 17. And this still, you can see this, yeah, 17% still hasn't reached the split. Let's take this down to like 13.5 and this down to like 15 and see. Yeah, there you get a little bit of split there. So if you go back to Waterfall 5, you've got, yeah, a little bit there. So you've got about, 17 months of 50-50, which is great for the sponsor. So now they're getting a bit higher return than they were. You see now the sponsor's internal rate of return is 21 in scenario 5. And if we put this back, It's only 20. Well, yes, it's not a huge difference, but it is different. So that's, I think this is a great tool to use. It's basic enough so you really all you need is just, um, fill in your pro forma to figure out what your cash flows probably look like. Adjust your assumptions in these scenarios. You can either hold everything else equal and just adjust one assumption, or adjust multiple ones and just see what all of your scenarios look like for the investor and sponsor. All right, that's all I got for you. This model, it'll just be in with, let's see, if you go to smarthelping.com, I have a waterfall model here right at the top tab. If you purchase this, you're going to have access to all the waterfall models I've ever built and all the real estate models. It's like $4,000 of worth of work that I've done and modified myself, so it's a pretty good deal for only $45. Uh, and the link to get to this page will be in the YouTube description below. So click through, go ahead and get it, and I'll send it to you. I think is really helpful. I've explained a lot of concepts that are really hard for people to get if they're not like in private equity and dealing with these deals all the time. It's hard to understand like as an investor how it works, and so this kind of sheds some light on this type of a waterfall uh, hurdle model for real estate, or I mean, you can just for anything. Real estate's just it's all cash flow. It doesn't matter what it is. It could be real estate. It could be anything. Anything that has cash flow, you could do this for. So there you go. Have a great Sunday.